Imagine if you could see the exact moves that banks and institutional traders make before the market even reacts. What if you could predict the liquidity hunts, the fake breakouts, and the true institutional orders that move billions of dollars? Today, I'm going to pull back the curtain and show you, step by step, how the market really works from the perspective of the big players. This isn't about indicators or guesswork. This is smart money concepts, the way professional traders think, enter, and exit the market with precision, while retail traders are left guessing. From the very first second, you need to understand that the retail trader's world is completely different from the institutional perspective. Retail traders chase price, hoping indicators will tell them the truth, but institutions don't trade indicators. They trade liquidity, order blocks, and market inefficiencies that most retail traders completely ignore. By mastering smart money concepts, you will learn to identify these inefficiencies and enter the market when the big players are moving, rather than when the market is simply reacting. First, let's break down the most crucial elements of SMC: BOS, break of structure, and CHOCH, change of character. BOS is a confirmation that the market has shifted from one trend to another. CHOCH, on the other hand, indicates the subtle but critical shifts in market character, often signaling where liquidity will be hunted next. Understanding these two concepts is the foundation of trading like the institutions. Picture a bullish market. Price has been moving upward, creating higher highs and lower lows. Suddenly, you notice that the market makes a lower high, followed by a break of the previous swing low. This is BOS. The structure is broken. But here's the secret. BOS alone is not enough to enter. You must combine it with CHOCH to understand the market's intention. CHOCH might show that although the structure is broken, liquidity is being accumulated for the next move up. This subtle observation allows professional traders to enter precisely where the institutions are placing their orders. Liquidity is the lifeblood of smart money concepts. Institutions cannot move billions without triggering retail stops. That is why they hunt liquidity. They look for areas where retail traders have placed their stops above swing highs or below swing lows. Once these liquidity pools are tapped, the market can move sharply in the opposite direction, creating opportunities for those who understand the pattern. Learning to read these liquidity zones is critical for predicting high-probability trade setups. For example, during a London session open, price might aggressively push above a recent high, triggering retail buy stops. This fake breakout is a classic liquidity sweep. While retail traders get trapped, professional traders are entering in the opposite direction, collecting liquidity and preparing for the next real move. By recognizing these patterns, you can position yourself on the right side of the market, avoiding the traps most traders fall into. Order blocks are another pillar of SMC. Think of them as the footprints of institutional traders. An order block is a consolidation area where institutions have previously accumulated positions. When price returns to this zone, it often reacts strongly, either reversing or continuing with momentum. Identifying valid order blocks allows you to align your trades with institutional flow rather than guessing where the market might go. Now, let's talk about combining these elements for a complete trade setup. Imagine a bullish trend in a major currency pair like Euro-USD. You identify a BOS, confirm the CHOCH, locate a previous order block, and check where liquidity might be concentrated. The confluence of these elements creates a high-probability setup. You enter at the edge of the order block with stops beyond the liquidity pool and target the next structure high. This method dramatically increases your chances of a successful trade because you're essentially following the footsteps of professional traders. Risk management is inseparable from SMC. Even with perfect analysis, not every trade will go as planned. Position sizing, stop-loss placement, and risk-to-reward ratio must all be calculated carefully.
Professional traders often risk a small fraction of their capital per trade, ensuring that no single trade can significantly impact their account. By combining SMC with disciplined risk management, you're creating a system that is not only profitable but also sustainable. Trading psychology is the final piece of the puzzle. Smart money concepts require patience, discipline, and emotional control. Many traders see the market and act impulsively, chasing setups that look good on the surface. The professionals, however, wait for precise confluence, BOS, CHOCH, liquidity, and order block alignment before entering. Cultivating this mindset is essential to consistently applying SMC principles and achieving long-term profitability.